Hi, and welcome back to the channel. Today we're going to talk about dividend growth stocks, in particular dividend aristocrats, as a way to create a stream of income going forward right up through your retirement and beyond. Hi, I'm Gerald Marquith. I'm a certified financial planner. I've been in the industry about 30 years, and this program is dedicated to those 50 and under for things they should have taught you in high school and college, but for whatever reason they did not. So let's kind of get into this. First of all, let's talk about what dividends even are. Dividends are given to shareholders of a company out of earnings that they make. They may pay these quarterly, annually, sometimes even monthly income. And of course, you share in those profits by getting dividends. Now, if you have those dividends inside a taxable account, guess what? They're going to be taxable. However, if you put them in retirement accounts, IRAs, Roth IRAs, 401ks if you can, these dividends would all be tax-free until, of course, you take money out, depending on the retirement program you have. So you want to think about how dividends work. Keep in mind that the company is free to not only raise dividends, but to cut them. When times get tough, they might even eliminate the dividends. Of course, you'd like to avoid that because usually when companies cut or eliminate their dividends, the stock price initially will fall as well. So what is it you can do to get a stream of dividends that is safer than the market? Well, let's talk in broad terms, first of all. And I'll use an example of 2022. The S&P 500, as you might remember, lost 18% that year. However, dividend aristocrat stocks fell 6.5%. Still a negative return. However, you see that dividend stocks can provide support during down times in the market. That's a good thing for you. However, it's not perfect. It's not totally going to avoid losses. So you want to think about what that means in terms of investing money. There's always risk in investing money. Are dividend stocks safe? No. Are they safer? Probably yes. But what you select as your dividend stock determines a lot. Let's talk about Warren Buffett's major purchase of Coca Cola stock back in 1988, where he invested money right all through 1994 in Coke itself. Now, why did he do that? Well, he figured out that about 1 billion people a day bought Coke products. And it didn't take much of a genius to figure out that with population growth, Coca Cola was going to continue to make more and more money over time. So we'll put up a chart here of what he did. He initially made a purchase of $1.3 billion. Today, that particular investment is worth $34.5 billion, which means his combined annual growth rate, compound growth rate, of 12% a year. Not bad, actually. His dividend income went from $75 million all the way up to $840 million, mainly because Coke continued to raise their dividends, which, by the way, Coca-Cola has raised their dividends 64 straight years. That's pretty impressive. Even through bad times, Coca-Cola was raising dividends to their shareholders. So here's a case where investing in a company like, say, Coke, that is very interested in giving shareholders increasing returns of the profit, that it benefited not only Mr. Buffett, but it can benefit you if you were to say, I think I want to buy Coca-Cola. Well, keep in mind that if you do that, you're not diversified, and Coke price can go down as well as go up. So you may want to consider dollar cost averaging if that's something you're interested in doing. But there's a lot of companies out there that increase their dividends every single year. Like I said, some of them even monthly. So let's say, I'm not really interested in investing in an individual dividend company, but rather in an index. So you might look at companies that are focused I'm talking about index funds, exchange traded funds if you want, or ETFs. There was a video I've done earlier about this. You may want to look at those kind of investments since they are professionally managed, and they'll pick out the stocks for you, which they believe will give you the best return in terms of dividends for you. Let's kind of look at a chart here, if we will. The three you might want to consider as an example in this arena is the Vanguard High Yield Dividend. That's symbol VYM. And if you look at some of the stats on it, actually quite impressive. Year to date, it's up 16%. Over a 10-year period, it's up 11.6%. And the dividend yield is 2.2%. Now, their operating expense, which is also known as OER, so if you're ever looking at an individual stock or ETF or whatever it is you're looking at, if you find that area of OER, it tells you what their annual operating expense is. That comes out of your returns. In this case, for Vanguard, it's a very low 0.04%, not 4%, 0.04%. That's one choice that you might look at. You might look at SCHD, which is the Schwab U.S. Dividend Equity Fund. Now here, the year to date, they're up over 24%, almost 25%, and they've averaged over 10 years about 13% a year. Very good number. And their dividend yield is higher, a little over 3% a year. The operating expense, pretty low, 0.06%. Now, in both of these cases, Vanguard and Schwab, it does not mean that they're investing solely in Dividend Aristocrat funds or stocks. Now, what is a Dividend Aristocrat? They've increased their dividends for 25 straight years or more. Dividend Kings have increased their dividends over 50 years in a row. As we mentioned before, Coke has increased their dividends 64 years in a row. Very, very impressive. But the mindset of Dividend Aristocrat companies is that they want shareholders to get an increasing part of the profits that they make. And make no mistake about it, that's coming out of profits. If they're losing money, it's very hard to maintain raising dividends or even holding dividends for that matter. So you want to be careful on what you do. So, do you want to invest in these kind of funds? Well, that's something you would want to consider. But whatever you do, you want to remember that you're going to have to hold this for a long period of time. And by long, I'm thinking 10, 20, 30 years. You might say, I'm not going to hold it 10 to 30 years. Well, the less that you hold it, the more risk you have that you may not get an overall great return. These are not investments you make with the idea of going in and out quickly to make a few dollars. You want it to grow over a period of time. And back to Warren Buffett's statement earlier that you make more money sitting on your rear end than you do buying and selling. That I suspect is a very true statement. It's not an easy thing to do, but it's a smart thing to do for sure. So if you're trying to increase another stream of income for you, you want to consider dividend growth stocks. Those are certainly worthy of your attention. Well, I hope you got something out of this video. I hope that you join our channel, subscribe, like it, and even share it with others who you think might benefit. Leave a comment in the comments section about what types of stocks or indexes you follow when it comes to dividends. I'm going to leave you with the final question: to invest or not to invest? That is the question. Have a good day.